Today, I am going to give you a link so you can use for free one of the private indicators with more percentage of hits and win rate of the last months, valid for all types of assets, such as cryptocurrencies, forex, stocks, and also we will teach you how to use it step by step, and a strategy that if you get to practice and perfect, could significantly increase the profits of your operation. Welcome to the trader's game. And before we start, remember that in the description you have the links to join us in our Telegram community, where every day we post charts and analysis of what is happening in the financial markets. And also the trading bonus page, which has been updated and have added new promotions and free bonuses for all those who are starting in the world of trading. Do not forget to leave your email if you want to receive a weekly newsletter with everything that has happened during those days. The indicator itself is called Big Guy, and when you activate it you get something like this. As you can see, it is able to provide us with a lot of information, both of possible reversals of the trend, as just happens in these areas, arrows and upward pressure volume, and also red bars that indicate even the reversal zones, in this case downward. But of course this indicator works much better in the company of two others, which we will add below. But first, as I promised at the beginning of this video, you have in the description a direct link to its official TradingView page, which as you can see comes out as a private indicator, but if you go down a little to this area we'll give you the option to add it directly to the favorites of your TradingView account, and by doing so simply by going to indicators and typing Big Guy and it will come out. And as you can see you can use it completely free of charge. But now we are going to add another indicator called Change of Volatility, specifically this one from BJR 117. Click on it and it will appear something like this. As you can see, just like this above, it can already give us indications of in which areas could be those floors or those ceilings where the price changes trend, i.e. here we can see how volatility is growing, and just in that area of maximum peak also coincides perfectly with the area of that reversal. The same could happen for example here. But of course to this we would still have to add something else to be able to adjust our operations to the maximum. It is nothing more and nothing less than the supply and demand visible range, the well-known Lux algo. We click and in this case this indicator shows us the areas of both supply and demand that is having the price in a given range, and here of course it happens that this indicator is repeatable, that is to say that it is moving as we move the cursor, because it is detecting the different ranges according to the amount of candles we are seeing on the screen, and of course at this point you will wonder how to know when to place it. Very simple, whenever we detect that it is forming a range. Imagine for example in this case that the price is consolidating, there is a big fall and again we return to retest that upper zone, we would already have that first, second, and third part, which indicate that we are probably forming a price range in which the price can be put to lateralize and zigzag. At that time, to make it a little easier, we mark both the supply zone and the demand zone on our own. That is, we use the indicator as a base, but we place our own zones, and of course in that case we would have something like this. If we want to lower the zoom a little and see the whole structure, we do not care that the indicator is moving. Even when we have our own marks we can hide it while we do the analysis so that it is easier for us and we are not confusing. At this point it has already detected the possible range. We reactivate the two indicators that we had placed, and we will place our operations based on the following. First, if we are looking for operations in short, what we must wait is that obviously the price approaches the upper zone of the range that we had marked as bid zone, and there we will wait for the Big Guy indicator to mark a negative red band, but that includes more than one candle. That is to say this one here would not be valid since it is marking us only one candle. However, this thicker one here would include at least two candles. At that point we look at the volatility change indicator. If we have any area well above the average of that volatility, or even if we see some divergence, i.e. we see that volatility is falling and the price is rising, then at that time what we should expect is that the price touches that supply zone, that there is a little more volatility, which means that there is a great bearish force that could drive the price in this case down. Even so, simply looking at this red tape we could directly place our operation in that area, with the stop loss above that supply zone, and with the take profit at 1.5 ratio, or even reaching the demand zone or the other end of the range. we would have something like this. Let's see what happens. As you can see, the price has continued to lateralize a little and has even come to retest it again, that supply zone, but without ever getting to overcome it. And as you can see, after having made a first attempt, in the end it ended up touching the lower end of the range. And what happens right after it touches that zone, in this case the demand zone? The price bounces and looks for the opposite zone again, and that is where the signal that would indicate a possible entry, in this case long, would come in. Just after making our short trade, we noticed that the price is reaching the demand zone, which we had marked from the beginning of the creation of this range. And to be able to launch our operation, we look at these triangles or yellow arrows on the big guy indicator, which are indicating a great bullish pressure, which could lead to a change of trend. We are going to mark just the candle that shows us, and we notice again that we also just come from touching the demand zone with a volatility higher than the average, which means that very probably in that zone or close to it there could be a change of trend. Now we can directly place our operation, in this case the stop loss below the demand zone, and the take profit again in ratio 1.5, or if the price is not strong enough to reach the upper end, or directly touching that supply zone. And as you can see, just after we have some movements exactly the same as we saw in the short operation, and is that the price has indeed first threatened to touch the top, as it did here in the previous operation, but the other way around, and again began to fall, retest again that demand zone, to finally boost and touch our take profit in the upper zone. And this is why I have told you that this combination of indicators is absolutely crazy, since by practicing and perfecting it you could achieve percentages close to 100% win rate. I invite you as always to try it for yourselves, and tell us below in the comments section what you think, if you liked it, and if you are already taking advantage of it. We also ask that if you like our work you leave us a nice like. It's free and it helps us to improve. Finally, let you know that in the description you have the links to our free Telegram community and to the Trading Bonus website, where all those who are starting in this world of trading, you can take a look at the best platforms and free bonuses so you can start off on the right foot. Thank you very much for watching, and see you in the next video of the Trader's Game.